Okay, in this video I'm going to be showing you how this strategy works for day trading instead of swing trading. But before we get to the video, check the link in the description for the full course and get 50% off if you use the top link. And to start off, there are two main differences between the day trading and the swing trading. The first one is instead of looking for the setups on the weekly time frame, for day trading now, we look for setups on the daily time frame. The same very setups that we explained in the last video, or the last couple of videos, where we look for a trading, we look for the trading bias, then we look for the trade setup, then trade entry. Then after that, after the trade is already taken, we manage the trade after. It's the very same thing, where we look for the W and M setups, trade setups, where on the downtrend, the M setup, we use the Fibonacci, and the W setup, we use the MACD and the exponential moving averages. And for the uptrend, we use the Fibonacci for the W setup and the MACD and exponential moving averages for the M setup. Same thing. The second difference now is that instead of looking for a 1-to-1 risk to reward ratio from the entry point on the W setup for the downtrend and the M setup for the uptrend, instead of looking for a 1-to-1 ratio between the entry and the neckline for the M and W, instead of that, we just take the trade and go for a 1-to-3 risk to reward ratio off the bat. That's the second difference, and that basically explains it. So let's jump into some backtesting. Right now we're on AUD/JPY, which is the Australian dollar against the Japanese yen. On the daily time frame, we'll be starting from right here. There's a setup right here. If you look closely, you can see the price is going down. Price broke this structure, this area right here, and starting going down. So we're looking for M's and W's, and in this case, our very first case, we have a W formation right here. W is trade setup, and the first thing we need to do, we switch to the line chart, mark out our neckline, put it to the very first point, or the very first bank point, which is 50. Very first bank point above the neckline, 50. Then we switch back to the candlesticks, and this is okay. Then we switch to the forward time frame and look for our entry. And when price is going down and we have a W formation, we look at the MACD and the exponential moving averages, the cross, for an entry. And as you can see, price broke the neckline over here. Then the 20 moving average, which is the red, the 20 exponential moving average, crossed the 10 exponential moving average, which is the blue, indicating that price is continuing to go down. So the next thing we need to do is look for where price cross the 0 point on the MACD, like what we explained in the previous videos, which looks like it happened right on this very same candle where the 10 and the 20 exponential moving average cross right here. So that will be our trade or sell right here, and the close of this candle. Put our stop loss above our previous resistance point, which could be right here, or you can even put it right here, but to be safe, you put it right around here, or it could be more safe by putting it up here, or put it right above here. Just 52 pips stop loss. We go for a 1-to-3 risk to reward ratio. and we got it. See, we got it. And this trade went all the way down for a for a 1 to 8.88 risk to reward ratio. But since it's a day trade instead of a swing trade, we just take the 1 to 3 and we're done. Which would have happened in about 8 days, around that, or just 1 week, short of 1 week, because we don't count the weekends. So about less than a week to hit the take profit for a 1 to 3 risk to reward ratio. So that brings us to the end of this video right here. That brings us to the end. We got 2 wins, no losses, which is pretty good. Couple non-trades, which you can't say is bad because you're not losing anything. You're only winning. So everything is good. Thank you for watching. Please check out my previous videos on this strategy.